Hello friends and welcome to Varical's Learning Vlogs. This is CA Prince George and this is my fourth video on the video lecture series on Income Tax Act 1961 that I have started. Today we are going to discuss three definitions and subsequently I will very briefly touch upon the idea of income, not the definition of income, just the idea of income, which will help us understand the definition better when I take that up in my next video. So let's start with the first definition of the day, assessment. Assessment, section 2, subsection 8. Assessment is defined as the procedure that an assessing officer follows in order to determine the income of the assessee. It's plain, completely unambiguous. So I'll just leave this here. Let's come to the second definition of previous year, section 2, subsection 34. Now, previous year is defined as the financial year in which the assessee earns the income. And the financial year starts on 1st of April and ends on 31st of March. Though it is not necessary that the financial year or the previous year will always be of 12 months. It can be less than 12 months also, depending on the day when you are starting the business. For example, if the business is started on 1st of or earning the income has started on 1st of June, then the previous year will be of 10 months, June to 31st of March, that is 10 months. However, a previous year can never be more than 12 months. It can be less than 12 months, but never be more than 12 months. From subsequent year onwards, the previous year will always be 12 months, right? Unless you stop the business in between. So that was previous year. Again, a simple definition, not much to discuss. The third definition of the day and the last definition of the day is assessment year, which is section 2, subsection 9. Now, assessment year is defined as the financial year immediately succeeding the previous year. And assessment year starts on 1st of April and ends on 31st of March, is always of 12 months. This basically means that if I start my business on 1st of June 2023, my previous year is going to be 1st of June to 31st of March 2024. That's 10 months. And whatever I have earned during this 10 months, from 1st of June 2023 to 31st of March 2024, will be assessed by the assessing officer in the year which starts on 1st of April 2024 and ends on 31st of March 2025. So it's very logical because the assessing officer can never assess or determine your income in the same year when it is being earned, as it is being earned. It has to be done in the subsequent year only. So that's why assessment year. And this idea of assessment year and previous year, this is very unique to Income Tax Act. You don't have any other statute in the country where you have the same concept, assessment year and previous year. Now let's start with an important idea, concept, income. Since we are discussing income tax, it's important to understand what income means. But as I said, even before delving into the nuances of the definition of income under the Income Tax Act 1961, let's first understand what income means outside the act, generally to every one of us, how it is being defined in the dictionaries, how it means to different people, different professionals. So income is a very subjective term which can mean different to different people, different to different professionals, is entirely dependent on the facts of the case. What we define income as or understand income as may be completely reversed by a court of law. So it can be very, very subjective and different. Let's try to understand how different professionals understand this idea of income. Let's start with accountant. For an accountant, the only source of defining any financial item is accounting standards, the biggest source at least. Now, in accounting standards, unfortunately, nowhere income is defined. Neither in IFRS 15 nor in Ind AS 115 or ASC 606 or AS 9. You have definitions of revenue in the revenue related accounting standards, but income is not defined. However, that doesn't mean that an accountant doesn't have a sense of what income is. If not in accounting standards, in the financial statements that are prepared, especially the profit and loss accounts, you have elements which at least closely resemble the idea of income. For example, you have EBITDA, you have PBT, profit before tax, you have PAT, profit after tax, you have EBIT. So even though income as an element doesn't exist anywhere in the P&L account or anywhere in the statement as an element, but the idea does exist in these closely resembling concepts. Now let us understand how an economist, an accountant, as we just spoke about, for an accountant it is very close to the revenue understanding of income. For him it's going to be a revenue receipt, which will be an income. Right, so that's an important takeaway from how an accountant would understand income. But economist is very different. Now, economist incomes are defined by multiple economists very differently. But a very popular one is by Haig and Simon. And there the emphasis is more on increase in the net worth or change in the net worth, incremental wealth. Because for an economist, the objective of defining income is different. It's not creation of accounting standard or creation of it's not creation of an accounting statement or financial statement or health or knowing the health of the business. That's not the objective. For an economist, the objective is much more macro. It is about a parameter to gauge the well-being, social well-being, right? And that's why parameter to gauge the wealth creation. So those are the motivators for an economist to define income, and that's the reason why for him it is really the capital appreciation, the wealth creation, right? The change in net worth, which matters more as an income. So that was an economist, which is more leaning to the capital understanding of income. Now let's see how English dictionary would define income. Right? Let's have another perspective here. So I have written it down here. I'll just read it out verbatim for you. This is Webster's English Dictionary, which defines income as a gain or recurrent benefit usually measured in money that derives from capital or labor. Now, an important takeaway from this definition is the recurring nature of an income. So, it seems that in the definition, emphasis is made on the fact that for a receipt to be an income, it has to occur periodically. Some periodicity has to be there, monthly, quarterly, weekly, whatever, daily, right? And of course, it's usually measured in money, so that means that non-money measurements are also possible. But important is the recurrence, right? So it appears it's quite different from the economist's understanding of income. Now, let's forget about all this and let's understand how how do we understand have always understood income. In our regular conversation, we do use this term very frequently, and people do understand what we mean. So, if I go and ask, for example, somebody, what's your source of income, he understands what I'm asking. Right? So, in general terms, um, generally for a layman, an income would refer to something which, of course, occurs periodically, and also something which he relies on to meet his expenses, right? To plan his future, to invest, right? Um, to plan for retirement, to plan for studies of the children. So this is what income, mean to us, to laymen, right? For us as a layman, it's important that it should come from a regular source. So if I'm asking someone that what's your source of income, he would always cite something which is regular. If he's an employee somewhere, he would say I'm working as so and so. If he's a businessman, I do trading in so and so. I am a manufacturer or so and so. But something which I do as a regular business. If there's a chart, if there's a CFO who earns say 1 crore in salary, and in some year he has made some profits in selling shares and securities, which he did not do, which he simply did on an advice of a friend, right? Did not put any efforts in that, and he makes some money. Even to that CFO or that employee of a company, if somebody asks him what is your source of income, he's always going to tell them it is employment. I'm a CFO, so and so place, right? He will never say that it's my shares are my source of income, right? Now that doesn't mean shares cannot be a regular source of income, or trading in shares can never be income. Of course, it can be income. But what needs to be considered is what is the periodicity of that income? Was that income, was a conscious effort or conscious action taken to earn that income, right? Is that an out of the blue income which is a windfall, which just happened? So these factors, and is that from a source which you consider as regular? Is that from a source that you would consider to plan your future, right? So there can be many factors in deciding, that we as a layman also, apply in deciding whether a certain receipt as an income or not, right? If I'm selling, say, my ancestral property now, and I gain huge sum out of it, now this is a windfall. For me, it's never going to be a regular source. I will not rely on selling, keep selling my ancestral property to earn my living. How am I earning my living? So that's an important consideration when we decide, as laymen, to define something as income, right? Now, in all these factors, that one thing that I see very common is whether it is accountants' understanding, whether it is understanding in the dictionary, or whether it is how generally we understand income is has a revenue nature, it doesn't have a capital nature. When we say income, it is usually we are referring to revenue receipts and not capital receipts. So what is the difference between a revenue receipt and a capital receipt? For example, if you go and take a loan from the bank, right? You do get money in the bank account, but that's not your income. That's a capital receipt. Similarly, if you sell a fixed asset, if you sell a land or a building, and you are not dealing in land and building, that was your fixed asset that you sold. The money that you receive is a capital receipt, right? The money that you receive as salary is your revenue receipt and is your income. The money you receive as commission is your revenue receipt and is your income. Money that you receive out of selling goods and services that you regularly deal in is your revenue receipt and is a part of your income, right? So these were the type of revenue and capital receipts. Similarly, the impact of these receipts can be different. When it's a capital receipt, it of course impacts the balance sheet, and the revenue receipt would impact your P&L account by way of reducing the expenses or increasing the revenue or the profits. Whereas in case of capital receipt, either it will increase the asset or reduce the liabilities. So again, we won't deep dive into details of nuances of capital receipt versus revenue receipt. As a takeaway from this entire discussion, predominantly it is the revenue nature of a receipt. If it's a revenue nature of a receipt, it is considered as income, right? And if it is not, then it's a capital receipt, right? So I believe that this has at least broadened your perspective on income, that there is no hard and fast rule. When we study now the definition of income, you will see a completely different point of view approach that the taxman has taken to define income, right? So thank you so much, friends. If you have any doubts, any queries, please do drop a message or just give me a call. I will leave my phone number on my channel. Thank you so much.